Today we are going to discuss how to donate appreciated stock to charity and save taxes. My name is Mike Caldwell, and I'm the manager of estate gift planning with United Way of Central Indiana. If you own appreciated assets outside of a qualified retirement account, donating these assets without selling them first can be a great strategy. It's particularly useful for people that have highly concentrated stock positions and want to reduce their risk by selling some of the stock. Donating stock, as opposed to cash, to a nonprofit can also be a way to increase the value of your gift, potentially benefiting both you and the charity. The potential tax benefit comes in two parts: avoiding capital gains and maximizing your charitable deduction. If you have appreciated stock that you have held for more than 1 year, you can donate it directly to a qualified charitable organization and avoid paying capital gains tax on the increase in value. For example, if you bought 100 shares of XYZ Corp. 2 years ago at $20 per share, you would have invested $2,000. Now it trades at $50 per share, so your shares are worth $5,000. If you sell the shares yourself, you will owe capital gains tax on the profit of $3,000. Capital gains tax could be as high as 20%. And if that's the case, you would owe $600, or 20% of the $3,000, to the IRS in long-term capital gains tax, which would leave you with $4,400 to donate to the charity. However, if you donate the shares directly to the charity, who does not pay capital gains taxes, and ask them to sell the shares of stock, personally you will not owe any capital gains tax, and the charity will receive the full $5,000 value of the shares. Another advantage of donating stock is that you can claim a tax deduction for the fair market value of your gift if you itemize. In our example, had you sold the shares of stock yourself, paid the capital gains tax, and donated the difference, your tax deduction would be $4,400. By forwarding the shares of stock to the charity and asking them to sell the stock, your gift would be $5,000 and your tax deduction would also be $5,000. This means that if you donate the appreciated stock as opposed to the cash proceeds, it's a win-win for both the donor and the charity. The donor can make a larger gift by avoiding the long-term capital gains tax, and the charity receives a larger gift. So how do you do this? Donating stock is not difficult, but it does require some planning and coordination. Here are some steps to follow. 1. Choose a qualified charitable organization that accepts stock donations. Many charities, hospitals, schools, and other nonprofit organizations will accept stock as a gift or donation. You can check their websites or contact them directly to find out how to proceed. 2. Contact your broker or financial institution and request a transfer form. You will need to provide information such as the name and account number of the charity, and type of shares you want to donate, and the date you want the transfer to take place. 3. Complete and submit the transfer form before the end of the year. To qualify for a tax deduction in any given year, you must complete the donation by December the 31st. However, it may take several days or weeks for the transfer to be processed, so don't wait until the last minute. 4. Obtain a receipt or acknowledgement from the charity. You will need this document to claim your deduction on your tax return. The receipt should include information such as the name and address of the charity, the date and amount of your donation, and a description of the property donated. And 5. Keep records of your donation for tax purposes. You will need to keep copies of your transfer form, your receipt or acknowledgement from the charity, and your brokerage statement showing the value of your shares on the transfer date. So in the end, donating stock instead of cash can be a smart way to support your favorite causes while saving taxes. By avoiding capital gains tax and maximizing your charitable deduction, you can increase the impact of your gift and reduce your taxable income, creating a win-win situation for the donor and the charity. However, there are some rules and limitations that may apply to this strategy, so make sure you consult your tax professional before making any decisions.